Hey, good morning, everyone. Marty Mazur here. Friday, the 2nd of June, 2023, with your end of week stock market snapshot. Going to keep this one really quick and get on to our weekly economic deep dive. And also, this is the weekend where we score our equity market conditions index, which we do once a month. And I'll talk a little bit about that, I think, here at the end in terms of what it told us last month and what we saw over the ensuing month. And that, by the way, is an indicator not designed to be anything remotely market timing, or I should say not necessarily market timing. What it is, it's just an indicator that we developed back in August of 2021, I believe, to give us just kind of a feel for the overall kind of conditions or complexion of the equity market itself. There's a dozen indicators in there, and so what we've done is these are indicators that we've tracked for years, if not decades, and use them independently as condition indicators for equity markets. Put them all together, score them once a month, and say, okay, is this the kind of market we want to add risk in? Is it the kind of market we want to be careful in, that sort of thing? Does it mean the market's going to move one direction or another over the coming month? No, but historically speaking, does it give us a good feel for the risk-reward setup? The answer would be yes, along with our macro index and all the other multiple things that we do. So again, I want to talk a little bit about that anyway, in terms of where it was last month and what the markets did over the coming month. And when I hit on volatility, I think we'll just take a really quick few second look at NVIDIA, Apple, and Microsoft. I did load those up. I want to talk about the VIX and just kind of talk generally about what we think's going on. And I think I'll do that here to start. So we had jobs numbers today. 336,000, I believe, was the number. Just touched the surface and dug down a little bit, just listening to commentary on Bloomberg TV this morning. I'll have to do my own assessment and share what I see and what we see in the economic update that probably is going to come to you later today when I think about the weekend schedule. So 330,000 is incredible, right? You'd think that the market would roll over because that's going to keep the Fed very much engaged, but underneath the surface, it was very mixed. Unemployment popped to 3.7%. Watched the market waver a little bit in the pre-market when it came out. But when all was said and done, it was a big sigh of relief with the underlying stuff. And, what's happened the past week? We've had the Fed pretty much come out and tell us they're not going to hike at the June 14th meeting. That the term now is skip. They're very careful to say, we've done a lot, we want to pause, we want to see what the data do. Market loves the sound of that. The survey data that's been coming out, I'll probably share a chunk of that in the economic update, particularly in manufacturing, continues to be, I can still say, abysmal, a little bit better maybe on the edges than it's been, but very much in recession territory. Lots of caution looking at the Fed's beige book, which is a look region by region. That one's a bit more sanguine than what we're getting from the regional manufacturing surveys, but still caution, caution, caution. That's what you keep hearing over and over again. We're being careful here. We expect things to slow down, so we're trying to bleed through excess inventory, blah blah blah. So it's clearly there's still this big fear of recession out there. The longer it goes on without happening, the less conviction there seems to be. Certainly conviction is waning about the bear market. And I'm going to talk a little bit there as well about that. I think there's a massive FOMO trade going on here. And that, I would almost say, fear of continued missing out by professional money that is beholden to, say, equity benchmarks. That's a rough place to be if you came in thinking that there's still more weakness to be had in the market and you acted accordingly and the market just continues to melt higher. Suddenly there's career risk there for some money managers and they get data like this, and it says, it's not all that bad. The market keeps melting up. The technicals are beginning to look a little better, and maybe we need to get some money into this market, and maybe even throw into the stocks that have the most momentum and ride this up. I mean, bubbles can go for a long time. The immortal words of John Maynard Keynes, the market can stay irrational, and in many ways it is, longer than you can stay solvent, right? So people may actually just be, crossing their fingers and closing their eyes and holding their breath and hoping on more irrationality, particularly if the Fed's going to ease up a little bit. Had a conversation internally yesterday where my contribution was, hey, the next couple of months, base effects are going to make the year-over-year inflation look really tame, all things equal. And we're seeing disinflation, certainly in the manufacturing surveys. So, we actually could get through the summer in pretty good form with the Fed, holding for a couple of meetings, right? If the economy doesn't roll over hard, which still remains our base case, it has to based on our assessments and how we score our indicators. But if it doesn't, if it continues to hold up, the last half of the year, July, pretty much through the end of the year, you have very favorable base effects, or maybe I should say unfavorable. All things equal, inflation on a year-over-year basis is going to look high, all things equal. Next couple of months, it's going to look lower, all things equal. And even though we should be looking at the month-on-month and understanding base effects, markets will look at that year-over-year. So, it could be that the next couple of months are okay, and that could be what some of this professional money is looking at, or this other professional money, I should say. We do not tie ourselves to any equity benchmark. I can tell you that right now. We refuse to live that way, and that would not be in the best interest of our clients, I promise you. But that's not the world a lot of people live in. So if they come to that conclusion that I just came to, they could get, a little bit optimistic at least, and maybe catch a bounce and start getting into some creative tactical, timing of the market and trying to catch up at least for a couple of months that way. One of the problems is, though, that the less bearishness there is, the less short interest there is, the less, therefore, cash in a position to buy stocks there is, the less support there is for the market. So if we get everybody running over to the bull side of the boat, that's going to make for a very dangerous setup. And that could play out sooner than later as well. So at the end of the day, I'm certainly not complaining. We had a great day in our core portfolio yesterday. We're having another good day today. But if sentiment does turn from decidedly negative to decidedly positive, and we're seeing that in advisor surveys, again, the more bullish it gets, the more near-term bearish it is for the market. So the technicals, folks, really nothing to report, right? Yes, we're getting a nice break above this rising wedge, at least the top of it there. But when I adjust my line, right, we still have clearly a bearish rising wedge pattern. That's what that is. Like I said here, this was a sell signal, particularly when we looked at our momentum indicators, right? We had a sell signal here. I basically said if there's any short-term traders and they want advice from me, I would not short that based on that sell signal. Typically you would, but we had the debt ceiling thing pending, and that was going to play into this, and that's no doubt plays into the bullishness this week as well. But what do we have here, folks? Again, you've got these patterns that have been pretty high probability patterns, that when you have this sort of situation, this loss of momentum, which is evidenced here in the rising wedge, and then confirmed by the moving average convergence divergence and an RSI, particularly as it gets close to overbought territory, you're really in that danger zone. So we're still there. So we'll see how that plays out. On the NASDAQ 100 index, again, more of a channel. I could draw a line right here. We have a shorter term rising wedge pattern. Pretty much have burned through the bearish divergence. This is bullish. So this breakout could gain momentum. We just don't have the bearish divergences, so we burn through those. Could actually gain momentum through this breakout, continue to rise, and then you just have the indicators moving with price, right? Now, we are very overbought on the NASDAQ. That's the short-term indicator in and of itself. And it doesn't mean that things have to fall apart necessarily. We're very overbought here, and we just kept melting higher. That could happen as well. Here we were overbought, right? We had some divergence here, just kind of at the top maybe. Had a little bit of a correction. Here, is where we really came down with a massive correction from basically overbought territory. And that just came swiftly. And, again, down in here, we can get very bullish on a short-term basis. We were right in here. And that, that was the beginning of something that's been pretty special here so far. And here and now, folks, looking at general conditions, looking at the technicals and so forth, this is a very heavy market that I don't think has a ton of upside to it. So NVIDIA has been a huge reason why the NASDAQ 100 has done so well. Massive pop on that earnings announcement and that outlook. And so we have it kind of consolidating up in here. If we got a big gap down, we'd have an island reversal pattern after this, and that would be about as negative as you could possibly get. So I'm not anticipating that, but I can see how that would play out. But yeah, nothing negative in terms of momentum. It confirms the move. Way overbought, right? We were way overbought here, though, right? And virtually nothing. We were, overbought here, but then we had some divergences building, and you got a pretty good percentage decline here, and so on. But yeah, I wouldn't pile in there personally, but I can't make a resoundingly negative technical argument. A lot of people would based on this, but I wouldn't. Apple looks very suspect to me still. Very definite rising wedge pattern. Very clear bearish divergence here. Still have one here, and we're overbought as well. Apple is actually negative today, a little bit, 3 basis points while the market is higher. Microsoft, no. Microsoft it looks better than Apple. The divergence has been burned through. Still a little overbought here. You do have your rising wedge pattern, and that is the right way to do that, the way we do it. Even have it here if I did it this way as well. So again, personally I wouldn't pile in here with our overall view of the world, but it's not as bearish as it was. This is getting some confirmation. The VIX is incredible, right? The VIX right now. And I need to update this chart. So right now it's sitting at like 15 something. Yeah, 15.12. So folks, we are plumbing new lows on the VIX. Really amazing. Okay, so the bear market goes back to here, and we're down at 16. So volatility is really, really cheap. We rolled our hedges yesterday. It's a good time to do that when volatility is so less expensive. From here, if our overall general thesis is right, the lower this goes, and the higher this goes, of course, the more pain is felt as things begin to ramp up. And a lot of this has to do with expirations and call buying and that sort of thing that are going on under the surface. The experts who we pay for their insight into the options market, they are actually not bearish right here, at least between here and the Fed meeting. They do show some levels that if something happened and we broke below those, it gets very bearish in a hurry. So there's some real cracking that can happen in this market if something comes up or for whatever reason we break down below some levels. But right now, that's incredible, frankly. Now, when we do our technical analysis on the VIX, it still looks pretty bullish and pretty bearish for stocks. We have clear positive divergences despite that sell signal right there, but the actual slope is positive. We have a very definite downward wedge pattern here, and we have a positive divergence on the RSI. So this thing is really primed to pop to the upside. Got to break above this downtrend line here to have a technical conviction there, but going to keep our eye on that. So lastly, again on breadth, as of the moment, the S&P equal weight is down 0.2%. The S&P 500 index itself is up, call it 11%. That's the biggest gap ever that I can certainly imagine. This is the kind of breadth that we haven't seen since 1999, and you get that analog, right? It was a disaster. So I mentioned our equity market conditions index. When we scored it right here, it's a minus 67. I believe that's the lowest score. It ties for the lowest score we've ever had, which says equity market conditions were miserable coming into the month. Now, stocks went down 3%, by the way. Doesn't look like it when you look at the S&P. My gosh, they went up 3%, right? But the S&P 500 in the aggregate, when you give all the stocks equal bidding in the index, it went down 3%. So yeah, the overall equity market had a really ugly month. Tech stocks, right, had a really good month. There is going to be reversion here, folks. I 100% promise you. The question is, does the S&P itself, the cap-weighted index, come down to here? Does this go up to there? Or do they meet somewhere in the middle, right? If those are the three options, in two of those three scenarios, this one comes down. So time will tell. And then lastly, global hedge fund, macro hedge fund index, down 0.4%. These folks are getting killed reputationally, right? So obviously they came into the year short, as conditions said they should. But if they give up the ghost and they start, going net long in a big way, that underlying support, that sort of positioning, as I already said, for the market begins to go away and things begin to get precarious. But folks, all of this remains to be seen. We're just truly being objective. That I can promise you. I am happy to be a bull. Longtime clients know what it's like when we are bullish. Right now, we are cautious to bearish for sure when we look at what we believe is left in this bear market. Having said that, like I said, yesterday we were up over 1%, and we're up nicely today in our core. Well, some things are breaking down. Looks like 1, 2, 3, 4, 5, 6, 7, 8, 9 of our 34 components are actually down. And gold's down 74 basis points, and that's not small. Silver's down 82. That's not a big position these days. Emerging market bonds, both local currency and hard currency, they're down. They're almost flat, but down a little bit. Interesting communication stocks, which have been rocking and rolling, they're actually down on the day. Our best performer today is Albemarle, the lithium miners, up 4%. Metals miners are up 3%. MP materials are up 3%. Oil services are up 3%. Brazil is up 2 2/3%. Materials are up 2.6%. How ironic. These are all the things that we like a ton in the next bull market that we are really looking forward to adding to. We added to South Africa here recently, or we added that position. It's up almost 2% today. Asia Pacific, which we are really bullish on long term, is up 1 3/4% today. But if we're right on our recession call, the things that are doing so well today are the things that aren't going to do so well, for a while in that recessionary scenario, which just isn't here yet, clearly, unless you're just looking at the manufacturing space. So, folks, that went a lot longer than I promised initially. Thank you for hanging in there. We're going to get right to work on the economic update and then on our equity market conditions index. And the latter will be reported to you early next week. Have a wonderful weekend. Talk to you soon. Bye-bye.